Everybody, Matt Graham, MBS Live here with you on Thursday, March 26th, 2020. Very late video today is working on an important piece for you. It's pinned in the news stream. Who broke the mortgage market and will it be fixed? Take a read. It talks about two things. It talks about all the stuff we've been talking about for quite a while with respect to rates rallying too much too quickly, prepayment speeds increasing, lenders moving to cash along with every other investor in the world in preparation for the fastest, biggest, most sudden recession that we've ever faced for the least expected of reasons. And all of the, counterintuitive movement in rates that created, as well as the volatility that came about from the Fed's response. But we then moved into part two, talking about this relief bill, stimulus bill, depending on what you want to call it, and the issue with servicing. It's complicated. It's not an easy thing to understand at first glance, but I tried to make it easy enough that you could share that with people that are asking you questions. It is intended to address the questions that don't seem to have any logical answer about, why you're suddenly seeing a big drop off in pricing in certain programs, or the complete change in underwriting guidelines, or the available credit box for any given program. And a lot of it has to do with servicing and the fact that these loans face a very uncertain future in the near term because of the relief bill and because people are being encouraged by the bill. It's not, and this isn't a bad thing, it's just a thing. They're being encouraged by the bill to embark on a forbearance journey, to ask their servicers to put their loans into a forbearance status. And that's a minimum of 6 months. And the servicer can't say no as long as the borrower says, I have a bona fide financial need. They don't have to provide evidence that they, are jobless or anything like that. So it's different than the check. I haven't even looked at what the stimulus check is, if there's an income cutoff or not, but I think, not everybody is getting one. Contrast that to the forbearance thing where pretty much anybody can get one. The bill only lays out, Fannie, Freddie, Ginnie, but that's most mortgages. And then the non-QM stuff isn't going to be protected in any way by any credit facility or any agreement that might come out of a conference bill tomorrow. Isn't going to be protected in terms of bondholders being paid or servicers paying bondholders if the underlying loans are not being paid on. So that would be why non-QM stuff is even harder hit, probably. I don't know. Somebody correct me if I'm wrong. It's labyrinthine logic, but hopefully that makes sense. Bottom line, investors don't know how well they're going to get their money on this stuff. And the bill doesn't guarantee that anybody is going to get their money when it comes to the mortgage market. And proponents of the recent changes suggest that the mention of this $454 billion credit facility from the Fed is evidence that the Fed's ready to backstop mortgage servicers. And they probably are. I mean, it makes logical sense for the Fed to take care of mortgage servicers. But if you are a servicer or a mortgage investor who's going to be a bondholder who's counting on the Fed to take care of servicers, are you maybe going to be more cautious until you know for sure that that's going to be the case? Of course you are. I mean, that's common sense. And I think even somebody who was in that exact position to be one of those bondholders and who was telling other people, hey, this is a good thing, I guarantee you, even they would still be cautious if they were faced with the decision of how much to pay for these bonds or whether or not to pay for them at all. And so when lenders are making those decisions to pay less for the loans that you are being hit on, you get hit on those loans. Non-QM, jumbos, cash outs, non-owners, and even FHA, VA due to the way that the servicing is paid, because 100% or a vast majority of that pool of loans is on the hook. The servicers are on the hook for a bigger percentage of that payment to bondholders than the average conforming loan. It's a complicated thing, but there's some conforming loans where both principal and interest have to be paid as scheduled, and some where it's just the interest has to be paid as scheduled. So it can be the same as Ginnie loans, but the fact that they're not all the same makes the conforming loans a little bit more desirable. And then my personal sort of conjecture, not something I've read elsewhere, is that, a Ginnie loan is a borrower demographic that is more likely to have a hard time coping financially with whatever COVID-19 hardships are going to arise, thus that much more likely to pursue the forbearance option. Pretty simple logic there. That's why all the stuff is broken. That's why really just conventional 30-year fixed stuff is doing the best. I think, 15 years have come back a little bit, but they're valued pretty well before all this. And I think that in an uncertain market with uncertain income for some households, it would make sense to me to consider refining from a 15 to a 30 if I wanted to lower my monthly bills. I don't know if you guys are seeing that. Let me know. But if you are, then that is kind of proof positive of the love that has been missing from the 15-year sector. It's also a smaller market in terms of volume and less liquid. So that also favors 30-year fixed over 15s. I don't know if the 15-year pricing discrepancy versus 30s is as big as it was today. It doesn't look like it's quite as big, but if to whatever extent you are seeing that extra refi demand there out of 15s into 30s, that would help explain that, in addition to the liquidity of being a smaller market. Anyway, will this ever stop? Yeah, eventually. We might be looking at that situation where property values go down, right? And so that's the kind of thing that's going to have to shake out. And this coronavirus thing is going to have some sort of stable conclusion, whether that looks something like, okay, hey, now this is part of the annual disease rotation and we got this vaccine and some people are going to get it. Most people won't. As long as we know what that looks like, then we can get back to normal. And if it's better than that, if it's the kind of thing where a vaccine and whatever else can make it really, really uncommon, I think the economy can get back to where it was even more quickly. But quickly in this case is like, I have a hard time wrapping my mind around scenarios that are any faster than, say, I don't know, beginning of next year. We could definitely be on the up and up well before then, but back to the current level of risk taking in the mortgage market, who knows? It could take that long. At the very least, you're talking about weeks at minimum, before you would see guidelines move in the other direction. And in all likelihood, it would probably still be moving in an unfriendly direction at that point. But it really depends on how things play out, how many people, take the forbearance option just because they have it. And that's going to depend on the evolution of the economy in response to coronavirus. So much uncertainty. I could go on and on about it, and I have been now. So I'm going to stop. That's going to be it. I'll be back with you guys tomorrow. Have a great rest of your day.